Assalamualaikum and a very good day to all viewers out there. Welcome back to my channel. Today I'm going to show you how to prepare a statement of cash flows using the indirect method. In my previous video, I have already shown how to prepare a cash flow using the direct method. If you are interested to watch and have a go of the videos that I have prepared, you may check that down the description below. And for today's session, I'm going to first show you the presentation of statement of cash flow before we could prepare it using the indirect method. So for your information, the difference between the direct method and the indirect method is just in the presentation of the cash flow from operating activities. The other two section, which is section 2, in my videos I call this section 2, cash flow from investing activities, as well as cash flows from financing activities. The two section or the two activities are exactly identical with the direct method. So our focus today is to discuss the presentation of statement of cash flow using the indirect method with our focus on cash flows from operating activities. As you knew from the previous video, the presentation under direct method for the operating activities has a different presentation as compared to the one under the direct method. Direct method and indirect method, the difference lies in the presentation of the operating activities. However, the total starting from operating profit before working capital, starting from cash generated from operation is exactly the same as compared to the direct method. So basically, we are going to just focus on the preparation under the operating activities. Okay, as a start, you should be able to recall, or perhaps you have some knowledge that operating activities has something to do with principal revenue producing activities of the entity that are not investing or are not financing activities. Okay, in a simple word, whatever activities that does not or do not match under investing cash flows or do not match under the financing cash flow, or they are not financing, they are not investing activities, they would be presented under operating activities. And for your information, the amount of cash flow coming from these operating activities are the key indicator, that to what extent does the business entity has been relying on its operation, on this business operation to generate their cash flows, where this is important for them to repay their whatever debt, to maintain the operating capacity, as well as to be able to pay the dividends to the shareholders, as well as maybe in the future making investment without some other external sources of financing. So there was some recap of that. You can check my video on the presentation of cash flow under the direct method where I explain further on that. Okay, as a start, you should know that when we prepare under the operating activities, the starting point is the profit before tax. So you need to start preparing your statement of cash flow if it's under the direct method by showing the profit before tax. So you need to take your profit before tax and put it as the first item under your cash flow from operating activities. If it's a loss, it will be put in a negative outflow, right? So it will be put as an outflow. But if it's a positive figure, which is a profit, it will be as it is, right? So it will be the starting point. That is also in the case where it is not directly being provided in the financial statement, or if you were talking about educational purpose in the question, it is normally determined by reconciling the opening balances or the opening balance at the beginning of the year of the retained profits with its closing balance, right? And then the difference in the figures of the retained profit at the beginning and the one at the end of the year will then be adjusted, right, to be able to get the profit before tax, where you are going to add back the transaction, which is item like income tax, where before this, when you prepare the profit or loss or the income statement, you deduct your income tax, right? So that has to be added back to reverse the figures shown in the statement of profit or loss. We are trying to say that before this, whatever that are being deducted will now be added. So it will be done bottom up to determine the profit before tax. So you have to adjust or add back the income tax. You need to add back any transfer that is made out of profits to other reserve, any bonus issue that were declared out of the retained profit to the shareholders, right? Remember, bonus issue are non-cash transaction. Or maybe these are the most cliche or the most common thing that happen to a company when they have their dividend expense. Either it is an interim or final dividend. So that has to be added back. Or if there is any premium or redemption that was written off to the retained earnings, right? Basically that. So these are just some common examples. However, you may also come across that there are things that you would have to deduct or reduce from the retained earnings figure or retained profit figure, where the difference between the closing and opening balance. So you need to go and deduct if it's a transfer that were made from other reserve back to the retained profit. For example, transfer from the general reserve back to the retained profit. So you may have to do some workings. You can just do it by way of having some kind of statement as you're working, or you can also set up your T accounts to be able to derive at profit before tax. Okay, that one can be done in my other question or other session. Right. So in this question, there are no figures. It was just to explain each item. Okay. Let's just go to the next one. Okay, after you have already done this, right, if you would see what I put here, that was actually the first step, which is to find the profit before tax, is the first step to find the net cash flow from or use in operating activities under the indirect method, under the indirect method. Okay, step 1 is to find out the profit before tax or any net loss using the tips that I've given you. Step 2 is that you need to adjust the non-cash item. Yeah, you need to adjust the non-cash item as well as non-operating item, non-cash and non-operating item from the profit before tax. So the adjustment for non-cash and non-operating item. So what are non-cash and non-operating item? Okay, non-cash, they are still operating items, but somehow they are being included in the statement of profit or loss or the income statement. It can either be income or expenses, because when you prepare your income statement or your statement of profit or loss, it is prepared based on accrual basis. So to arrive at the profit before tax, you use accrual basis. However, that item, which are non-cash items that I have put the long list here, yeah, normally you just have a few items that you may come across in the question. The common one are finance cost, interest expense, dividend income, interest income, depreciation is the most mostly discussed, right? But I have put a long list here for your reference, right? So those are the things that you might come across. These are quite an extensive list, but this is not conclusive. Okay, the non-cash items have been included. So therefore, what you need to do is, since it does not involve any cash outflow if it's an expenses, or it is also not involving any cash inflow, if it's an income, you need to do some adjustment where you are going to add back any non-cash and non-operating expense back to the profit, and you are going to less or deduct the non-cash and non-operating income from the profit before tax. Okay, what are the non-operating items? Non-operating items can either be non-operating income or non-operating expenses that have the cash effect, right? So meaning that it has some cash effect where it brings cash inflow, or if it's an expenses, they used a cash outflow, but it is related to investing or financing activities. However, they have been included in the statement of profit or loss, or in the preparation of the income statement to arrive at profit before tax. So what we need to do is to remove or adjust out or to exclude these items in order to arrive at our so-called operating cash flow. Remember, we are preparing statement of cash flow, so we need to do some reconciliation, which is to convert those items to show that this is the cash flow or the operating cash flow, which is a statement here that is based on cash basis. Okay, so these are the items that I have put and shared with you here. Okay, finance costs. Finance costs or interest expense. This one are normally the one that are being included to arrive at the profit before tax. However, these are also non-operating expense with cash effect, and it relates to financing activities as prescribed by IAS 7. So it relates to financing activities, but it has been deducted. If you look at in my note that I provide here, has been deducted earlier in the SOPL to arrive at profit before tax. So now we are adding it back, because before this we deduct. So it was just the reverse case. Dividend income before this, what you do is that you add to the calculation of profit before tax. So now what you do, you are going to go and deduct or minus to arrive at the operating profit before working capital changes. Why? Dividend income is actually a non-operating items with cash effect, and therefore, because it is a non-operating item, you receive dividend or you earn dividend. If you talk about income here, you earn dividend because you invest in equity instrument. So therefore, that has to be removed, because this is related to the investing activities. Yeah, but it can either be investing or financing activity. But in our case here, dividend income is related to investing activities. Next. Interest income is the same thing, where these are also from investing activities. Earlier you added, now you need to deduct. Depreciation, as I said, depreciation relates to non-current asset, right? So you provide depreciation, they are non-cash item. But somehow you include the depreciation, right? When you calculate your profit before tax. It was put under admin expenses. So now whatever that you have deducted, you will add back. Deficit on revaluation on non-current asset. These are, for example, they were using revaluation model and the asset was revalued downwards. And let's say PPE was revalued downwards, and it was the first time or the initial revaluation. So you debit to the profit or loss, right? So the one that you debit to the profit or loss, that is a non-cash transaction. So non-cash transaction or non-cash item has been earlier debited. Now you need to go and add back to the profit to get the operating cash flow. And this one is related to share issuance expense under financing activities, where you issue shares and there are issuance costs. Issuance costs are written off to the profit. So when it is written off to the profit, it was earlier been debited to the profit. Now you need to go and credit the profit or go and add back. Premium on redemption, maybe you have redemption of debentures, you have the premium was written off to the profit or loss, so it was earlier been debited, it has been deducted, now you need to go and add back. So whatever the rule is, that it was the reverse rule. Amortization, okay, amortization are similar to depreciation, but amortization is provided for the intangible asset. So amortization has been debited, so now you need to go and add. So whatever, simple rule here is that whatever expenses that were earlier deducted, now it will be added back. Whatever income which are non-cash and non-operating income that were earlier being added, now it will be deducted. And I'm just putting the list to let you have some ideas of what are other possible things that can be listed in the or be adjusted under non-cash and non-operating items, because most of the situation or the example tend to focus on just a few items. So I'm just trying to give you a long description to help you with other situation if you may come across. So research and development expenditure, this is for example under IAS 38 intangible asset, or in Malaysia that was MFRS 138 intangible asset, where if there are any research costs, it has been written off, right? Development costs that do not meet the capitalization criteria was also being written off to the profit. So those things must be added back because they are non-cash expense, right? Non-current asset written off, okay, when assets are no longer being able to generate future economic benefits of the company, or therefore due to whatever disposal or not really disposal, maybe you write off because it cannot produce future economic benefits, right? So that those assets are being written off to the profit. So those assets have to be added because earlier it has been written off. Written off means debit, profit or loss, credit that particular asset, right? Particular asset like let's say PPE. Impairment loss of non-current asset because it is an expense, so you need to go and add back. This happened to, for example, for the PPE and the intangible asset. Decrease or increase. For the decrease, if it's a decrease in allowance, you need to go and add back. If it's an increase in allowance, right? Increase, you have to add back. The decrease, as you can see the signage there, the bracket there, right? It shows that you need to reduce. This is, for example, for the impairment of receivable, where there was an increase in the estimation of the percentage that are considered or estimated as uncollectible. So that one is under IFRS 9. Decrease or increase in provision, like in the case of IAS 37, if it's an increase, it will be added back. Decrease, it will be deducted. Gain or loss on disposal of non-current asset, maybe non-current asset like PPE, you dispose. If before this a loss was being deducted, now it will be added. You can see the signage here. The one which is added is for the loss. The one that will have the bracket sign is for the gain. Or maybe that one is for non-current asset. Or maybe gain or loss from the foreign currency exchange transaction, right? If the gain earlier was being added, now you will go and deduct. And the last one, not last one, it was just some examples that I have managed to figure out for you. Now, if there is any gain or loss on fair value change here could relate to fair value change when you adopt fair value model for your investment property, or you adopt where you have your biological asset that also use the fair value model. And if you have any gain or loss on the change in the carrying amount or carrying value as compared to the fair value. For example, in the case of biological asset, fair value less cost to sell. So that has also need to be adjusted here because these are cash expense if it's a loss. It is a non-cash income if it's a gain. So gain will be deducted, loss will be added. So in a simple word, expenses that are non-cash and non-operating expenses will be added back, and the income that are non-cash and non-operating income will be deducted. After you have done that, you will get your operating profit before working capital changes. If you have an operating loss, you will put a bracket there as a negative, or that it shows an outflow. And you need to do the third step, which is to adjust the working capital. For your information, working capital is the different, or looking at what happened to your current asset and what happened to your current liabilities. What are the changes to this current asset at the beginning of the year and at the end of the year? Yeah. For example, you are looking at whether there is a decrease in current asset or an increase in the current asset. So increase in the current asset will be deducted. I will explain why. Decrease in the current asset, it will be added back. Increase in current liability, it will be added. The decrease in the current liability, it will be deducted. Okay, let's look at the explanation here. Okay, I show the note for you. So this, for example, if you talk about decrease in current asset, so let's just go into the example of what are current asset that you should have included here. These are, for example, items like inventories, which are under your current asset section in your statement of financial position of your balance sheet. Your accounts receivable, you need to look at the movement of it. What are the closing balances as compared to what are the opening balances? See the difference, whether there is an increase from the one at the beginning of the year to the one at the end of the year. So compare the closing balances with the opening balances, just like what you did in your direct method, but here is indirect method. You just need to compare that to accounts receivable. This is not doing a consolidated cash flow. Yeah? Bear in mind, we are just doing a single statement of cash flow. Items like prepaid expenses. Here we are talking about prepaid operating expenses. Income receivable. We are not talking about dividend income receivable, but we are talking about income, operating income receivable, or maybe contract asset. This is under IFRS 15, where you have the revenue recognition from the contract with the customer. So this is not so to be discussed here in detail. You can check that in other lectures, right? And so all this, so you need to go and list down decrease in current asset. Here, maybe here decrease in inventories, decrease in receivable as one more row, and decrease in let's say your prepaid expenses, or increase in that. So decrease. Why? What is the adjustment? I mentioned earlier, decrease will have to be added. Why do we add? We add because we have more cash receipts that are collected from the customer. Let's say you have a decrease in accounts receivable. From the closing opening balance, now at the end of the year, it has reduced from 100,000 maybe to 70,000. So that 50,000 indicated that you have managed to collect some cash from the customer. So therefore, it is being added. For the case of the current asset movement here, you should exclude the cash and cash equivalent, because that is under cash and cash equivalent. You should also exclude tax recoverable, yeah, or then you should also exclude other current asset like dividend receivable and interest receivable, because they have their own special place, which is under the investing activities. Tax has been disclosed separately also in operating activities. So you just focus on the operating assets. Operating assets. Okay, this if the rule there, if it's for the decrease, you are going to add. So now let me just hide this for you. If it's for the decrease, so therefore, for the decrease in current asset, that indicates, as I said, more cash are being collected. So now let us look at the increase. There is a typo there. Let me just do some correction here. Here should be an increase. Okay, increase in current assets are being deducted. Why do we deduct? Yeah, the issue. This is because, let's say your account receivable, for example, at the beginning of the year, it was 100,000. At the end of the year, let's say it becomes 150,000. So that indicated that the business has not been able to collect the amount due to from the customer. So therefore, that will reduce the cash flow, right? So therefore, the increase in current asset are being deducted. The decrease is being added. Okay, next. This one is regarding your increase in current liabilities. So increase will indicate that more cash is held. What are current liabilities that should be adjusted here? Accounts payable, yeah, accounts payable or your trade payable, bill or notes payable, which are less than 1 year in terms of that. And then accrued operating expenses. We're not trying to include accrued interest here, right? Accrued operating expenses. We're not trying to include any accrued dividend here. No. Yeah, accrued operating expenses. Unearned also operating income. So those are all example of liabilities, which are current liabilities and contract liabilities. That will be expected to be realized in 1 year. Unearned revenue. And then you will also have to exclude items like bank overdraft because they are cash and cash equivalent. Under the cash and cash equivalent, tax payable because it has a special line item that where it will be disclosed under tax paid, right? Non-operating item with cash effects such as dividends payable and interest or finance costs payable. Some typo there. Okay, now so that one has to be added back. If that is the case, let us look at the decrease in the liability. So if there is a decrease in the current liabilities, that would indicate that more cash payments are made to the supplier. Why? Because you need to pay your supplier since your debt has gone down. So when you pay your supplier, you reduce your cash flow. So when you reduce your cash flow, you need to go and deduct in your working capital changes. Okay. After you have done that, you have to make sure that these are presented separately. For example, you can show your expenses in one line item. You can show your accounts payable changes in one line item, and also the accrued items like contract liabilities if you have in one line item. Then you will get your cash generated from operations. After that, you will have to go and adjust for your tax that you actually paid. When we adjust tax paid, we are trying to look at how much is the actual of cash outflow that we have paid to the Inland Revenue Board, yeah, for the tax in the current accounting period. So what you need to do is that you need to calculate the total tax paid, right? Where the amount of taxation must be adjusted first with the tax payable and tax recoverable item. You can check my video on direct method where I also show you regarding the calculation of income tax paid in that video. The next one is the finance cost or interest paid. Finance cost or interest paid is shown here again is because you need to separately present that to show the ability of the entity to pay the interest out of operating cash flow. So you need to tell your users of financial statement that if I use my operating cash flow, these can still be used to pay out my interest paid, right? So interest paid is the actual outflow of cash paid for the interest in the current period or current accounting or reporting period. So that will then give you the last total in the section 1, which is operating activities, and you will now get your cash flow from operating activities that I denote as Y. And for your information, if you add this with cash flow from investing activities and you add that with cash flows from financing activities, your total will still be Y plus U plus S, which is the three totals from the three activities. With that, I'm just explaining the presentation of statement of cash flow using the indirect method, where it started with the profit before tax and doing some adjustment for the second step for non-cash and non-operating items. The third step, I do adjustment for working capital, and my fourth step is that I do adjustment for the income tax paid and my interest paid, right? With that, I thank you. I will continue with another video showing how to prepare the statement of cash flow using the indirect method with the focus on cash flows from operating activities using the same example of my company I call Limelight. Just to let you know that I've done this for my direct method. So now I'm going to do it for my indirect method. So I've done this for my direct method before this. So we're going to see whether we can get this 100,000 or not. Of course we will, using our indirect method. With that, I thank you for watching. I will see you when I will see you. And I hope that you will learn from my session and will benefit. If you like the video, keep on sharing it and do subscribe to the channel. And if you would like to have more, just click the notification bell. Thank you, and I will see you around. Bye.